When you talk about catching the markets off guard, are you talking about rate hikes or the balance sheet unwind or both?
Potentially both. So when you look at the commentary sounds dovish, and that's what the market has come to believe and priced in. But when you look at the dynamics of what we've seen in terms of inflation, the Fed didn't buy into the big rise in inflation at the start of the year, and now I don't think they're going to buy into the transitory fall in inflation right now. So at the end of the day, inflation is on the rise, and I think Fed will be more hawkish that market is expecting.
Still, Nader, the markets may be surprised, but when it comes to the impact, that could be a different story. The chart 7163 showing that U.S. financial conditions are still very, very loose. In fact, sort of the easiest in a decade, which has helped boost the EM carry trade index as well. So it still seems a long way for this unwind to happen.
This is precisely my point. So since the Fed rate hikes began, financial conditions have actually eased. And that's not in a tightening cycle. I mean, obviously, you don't want to lead to a abrupt tightening on financial conditions, but you do want to test the waters and see some tightening in financial conditions and see if the economic backdrop is strong enough to handle that. Whereas what we've seen so far, it's just been the easing in financial conditions, and obviously the fall in the US dollar has helped. So I think that would give the Fed more leeway to pursue further rate hikes, which again, as you said, measures of carry trade. The market complacency around a dovish Fed is so high, and that's led to some, very strong, very crowded momentum carry trade in some of those EM currencies, and I think that will be at risk of reversal, at least in the short term.